This is George Herrera, and this is the third try on this stream because I'm trying to share a fantastic presentation from Carlos Lara, who has tremendous wisdom in the economy of small businesses. And well, I said all this without introducing you to the video or the stream. This is about protecting your purchase power. And to protect our purchase power, we have to earn more money or avoid interest, fees, penalties, and taxes on the money that we earn. And we can do that. We get a lot of help to do that of protecting our purchase power from the infinite banking concept, which is a tremendous process that uses a dividend paying whole life insurance contract and banking strategies. So I wanted to share with you this video from Carlos Lara that is going to give you tremendous information. It's going to give you tremendous information. Okay, I got that. So let's see how this goes here. Okay, I got that. So let's see how this goes here. Okay, I got that. So let's see how this goes here. Okay, I got that. So let's see how this goes here. Okay, I got that. So let's see how this goes here.
Welcome to lesson number 10. In this lesson, you will learn why IBC works perfectly for the business owner. The reason is because cash flow management is a fundamental precept of business, and IBC provides the perfect banking alternative.
In 2018, just 1 year before his death, Nelson Nash wrote and published his very last book. It was co-authored with Nelson by the board of directors of the Nelson Nash Institute. This slender volume that I'm holding up for you to see is that book, and it's titled The Case for IBC. This book is unique because among all the things that it teaches, it also teaches IBC, especially for the business owner. For that reason alone, it teaches IBC to be read by anyone that is either now practicing IBC or wishing to do so. Right away in chapter 1, this book begins to instruct the reader on how to think like a business owner. Then moves to a discussion on profit, followed by cash flow. Then the role of credit. Then commercial banks and lines of credit. And finally ending with a frank discussion on understanding the stranglehold that the commercial banks have on most business owners. As you can tell, this is an interesting topic, and we have a lot of ground to cover. So let's begin. The case for IBC. So as ambassadors and advocates of IBC, this is what we do when we talk to people. We make the case for IBC. And so what I'd like to do this morning is to give you a perspective on IBC from the business owner's view. Give you a perspective now, on IBC from the business owner's view. All different kinds of businesses for now 4 decades. and they will sell and manufacture all different kinds of products. And what we're doing here is trying to solve a huge financial problem. And what we're doing here is trying to solve huge informal reorganizations outside of bankruptcy. And so the idea is to meet with all of the creditors of the businesses and all of his banking relationships and try to get these people to come together to help solve the problem and hopefully get paid. Now, during this period of time, I have spent a lot of quality time with business owners, traveling around, dealing with the business owners' problems. And these assignments are all over the United States, and they will go for 1.5 to 2 years to solve. So during this quality time that I've spent with business owners, I've gotten to understand their personality. So I can tell you a lot of things about business owners. First of all, I respect them very much because they are entrepreneurs and they're the ones that make our economy hum. They're risk takers, okay? So I do have respect for them. Now, I'm not saying they're brighter, more special than anyone else, but they do see the financial world differently. Now, a couple of things about business owners is that they don't really care for financial products. They don't like things like life insurance. They don't really care for financial products. Stocks and bonds. They don't like things like life. Now, I'm not saying they don't have these things. They're just not keen on them. This is not what they're interested in. Now, they do buy assets, but they like hard assets. Now here I'm talking about land. They will buy land. They like land. They like brick and mortar, real estate. They will buy real estate. A lot of them like the precious metals. And they all like cash, like the rest of us. But the reason they don't like these financial products is because they feel that their primary asset is their business. They feel that this is where they're going to get the highest rate of return, more than anywhere else. And so this is where their focus is. This is where they spend all their time, all of their energy, all of their money, blood, sweat, tears, just focused on their business. Now, I'll tell you another thing about business owners. A lot of people believe that business owners are long-term planners. They're not. They're basically thinking, next 30 days, how do I get there? Or the next 60 days. What's happened last year is history. It's not important anymore. They're focused on the 12 months in front of them. So they're over here at the beginning of the year, January, February, and they're looking down the corridor of the future of the months ahead to get over here to November, December. If they make it here, their goal is to make a profit. And after all, this is what they're in business for. Now, they know that if they make the profit, they're going to have to pay some tax on it. But after they pay the tax, they're going to wind up with a residual amount of money. And I'll tell you what they'll do with that residual. They will either buy another business asset because it's going to help their business. they'll pay down some debt, or 9 times out of 10, they will plow that residual money right back into the business. Why? Because this is where they get their highest rate of return. This is how they think. Now, just having told you that much about business owner, what do you suppose a business owner's number one concern is? Something that this has got to be coming in every single day without fail. If you're guessing it's sales or revenue, you're absolutely correct. This has got to be coming in every single day without fail. Why? Because every single day he's got money going out the door. He's got to pay expenses. And if those sales are not coming in, he can't pay them. Now, just right here, if you're not a business owner in the audience, can you not relate to this? That paycheck's got to come in, or you can't pay your bills. Same thing with the business owner. What do you suppose the business owner's number one expense is? Now, if you've guessed that it's payroll, again, you're right. Payroll is a business's number one expenditure. This is why when their industry goes south or there's a recession, the pink slips come out. They let go of people, because if they don't, the sales are going to be declining, and this expenditure alone will eat up the company. What do you suppose the business's second biggest expenditure is? It's rent. Rent. The space where the warehouse is, the locations, the various branches. That's the business's second biggest expenditure. Just with these two expenditures could be as much as 35% of annual revenue, just with these two. Now, the business has other expenses, of course. We can all just guess it's a long list. He's got to pay insurance, he's got to pay utilities, cell phones, lease equipment, all kinds of things. And so this is why these sales have got to be coming in, so he can meet all of this. Now, there's another item that's very closely related to sales and revenue, and something called accounts receivable. Now, accounts receivable, this is when this business sells products or services to other entities on credit. So they have time to pay, maybe 30 days, 60 days to pay the invoice. And not until they pay that invoice does it get added to sales. So businesses will have an entire department with a credit manager just devoted to looking out for these uncollected funds, because they could represent hundreds of thousands of dollars. And one of the reasons why he has a whole department looking after these is because these things tend to get late. People will ride that dating. If they get too late, they go bad. And so it's not unusual when somebody gets way out here at 120 days or 180 days that the business owner himself will pick up the phone to call that delinquent account, find out where his money is. If you're a business owner in the audience, you ever done something like that? Yeah, I have. You pick up the phone to find out where your money is, and 9 times out of 10, you get a weather report. I'm serious. Carlos, it's you. Oh my goodness. You wouldn't believe it. The skies opened up. I mean, we got dumped on. 15 inches of snow. We're buried here. The whole city shut down. Nobody can move. But hey, as soon as the things thaw out, that check's in the mail to you. You don't get your check. You get a weather report. That happens quite often. Now, business owners, above all people, realize that sales don't always go up. Sometimes they go up, sometimes they come straight down, then they go up again, then down again, and sometimes they're just plain flat. As we end part 1 of our narrative, you have realized that I am teaching you the material while simultaneously setting up a visual timeline of the information. This visual timeline also appears in the pages of the actual book, The Case for IBC, as an ongoing resource for future reference. Obviously, we still have more information yet to cover, and that all continues next in part 2 of IBC for the business owner.
Well, you see, it's very interesting the way that Carlos Lara puts together this problem that the business owner has. So I'm going to share with you the part 2, where he explains how not only the the depth of the problem of the business owner, but how to solve it. So let me put this part for you. So here we go. And please put any comments if you think, if you like what you are hearing, put some comments. And if you want more information, then put your contact information and I'll provide information for you. So this is George Herrera. I am a passionate advocate of the infinite banking concept. So here is the second part.
We last left off in our discussion as we were explaining that sales revenue doesn't always just go up. And that's because all businesses are by nature seasonal. They will do more business in certain months of the year than in others. Some businesses have to make up the entire annual revenue in the last 2 months of the year. Businesses have to make up. How would you like to be in a business like that? As you can see, and as you can tell, that can get very stressful for a business owner. And we will find out why. So let's pick it up from there and continue discussing our visual timeline. That's right. All businesses are seasonal. They will do more business in certain months of the year than in other months. It doesn't matter what kind of business it's in. You know, there are some businesses that will do 60 to 65% of their entire annual sales in the last 60 days of the year, these last 2 months. How would you like to be in a business like that, where you're running flat most of the year, and then you have to make it all up in the last 45, 60 days? What happens if you don't make it? Disaster. And that happens quite often. It's disastrous. Now, there's one other item that the business owner is very concerned about paying on time. And this is an item known as accounts payable. Now, accounts payable, these are the suppliers of the business. They ship merchandise and products to this business. And the thing about these accounts payable is they ship it to the business on the very same basis as this business ships these guys on credit. So the business has time to pay on these invoices. Now, business owners view these suppliers, these accounts payable, as very important people. And the reason is because the dating that he gets on this, okay, that's a form of working capital for his business. Financing. He can receive the merchandise and have time to sell it before he has to pay for it. So he wants to make sure that he pays these guys on time, because he wants those credit channels, opened up at all times. He doesn't want to run late with them. Now, I'll tell you one thing about these suppliers. When these suppliers ship inventories, merchandise to the business, the minute that merchandise hits the warehouse of this business, the title to that merchandise changes hands. It's no longer the inventories of the supplier. Legally now, it is the merchandise of the business, even though he hasn't paid for it. So in the line of work that I do, I refer to these guys as unsecured creditors. Why? Because they're shipping merchandise with no collateral. It's open credit. So what these suppliers have to do constantly is monitor the financial well-being of this company. They need to be looking at financial statements and balance sheets to make sure that this business is still creditworthy for them to continue to ship them product. Now, just stand back and look at this for just a minute. You see this business owner is taking money from here, paying over here, and going over here, sometimes robbing Peter to pay Paul. Being in business for yourself is can be nerve-wracking. It's not for everybody. It's not for everybody. This is very challenging to be in business. He's got to deal with all of this. Stressful. Business owners know that more important than profit and loss, more important than the assets and liabilities on a balance sheet, is cash flow. cash flow is king. And he sees his primary role as a cash flow manager. He's in cash flow management. That's what he's doing all the time. And when businesses get in this kind of situation, this is why you see they generally reach out here and engage the services of a commercial bank. And the reason for that is because commercial banks are in the business of granting lines of credit and loans, which, by the way, is what they do. And so the business owner gets at a point where he says, you know, I got so much volatility going on with my cash flow, and I'm going to need the services of a commercial bank to help me out with that. Now, you might think that's a difficult relationship to get started, but it really isn't. That bank is waiting for that relationship to happen. And the business owner may approach someone he goes to church with that he knows is a banker, works for such and such bank, or maybe it's the guy he went to school with. And so, yeah, the banker says, oh, Jim, great. I want to do business with you. Of course. Be glad to help out. Now, because we're going to be working with you and we're kind of partners in the business now, the only thing we request is you make sure that all of your revenue goes into our bank. So all your deposits are made here with us. Now, Jim, the business owner, may think, well, that's fair enough. I mean, I need a safe depository for all my funds to go into. No problem. So the minute this is set up, the business owner now begins to tap that line of credit when he most needs it, and now he's using the line of credit. But now the business owner has a different goal. It's not so much this one, the profit. He now wants to make sure that when he gets to the end of the year, that he pays off that line of credit. That becomes his main goal. Now, why would that be? Well, because he'll want to use that line of credit next year. It needs to be there for him to continue to operate. So that becomes his main goal. And as long as you've got a business that is operating this way, the business owner is paying off that line of credit at the end of the year, the banker is very happy, the business owner is very happy. So what do you think happens if all of a sudden he has a bad year? It happens. And he's not able to pay off that line of credit by the end of the year. What do you think's going to happen? Well, he's going to get a call from his friend at the bank. He say, you know, Jim, you didn't quite pay off that line of credit. It's no problem. Tell you what we're going to do. We're going to set up a short-term note, okay? You know, not too far out there, but you know, short enough where you can deal with it. Let's say a year. So we write out a note. You'll have 12 months to pay. And come on into the office, sign the paperwork, and you'll be good to go. Does that sound okay? Now, Jim, he's already got an uneasy feeling about this. He's mad because he wasn't able to do this. He doesn't really have a choice, so he goes with it. He signs the paperwork, he comes back and he starts to realize, you know what? This is another bill I've got to pay now. I've got to pay terms, you know, principal plus interest, and you know what? I got to make it on time. And not only that, my line of credit has been reduced by the amount of that note. This isn't working in my favor. he vows to himself, this is not going to happen next year. I'm cleaning up that line of credit. I'm going to clean up this note and this line of credit. I'm not going to allow this to happen. But what happens if that doesn't happen? Supposing there really is a recession. You know, during the big recession we had, there was a lot of this going on. Well, he's going to get another call from the banker and say, you know, Jim, not only were you not able to pay off the note, but you didn't finish up on the line of credit. You know what? Don't worry about it. Okay, it's not a problem. We're here to help. How about if we extend this first note for another 6 months? And then we'll just do another note for the amount that you were not able to clean up on the line of credit for another year. Does that sound okay? Well, it's not okay for Jim. This is not a good scenario for him. But he couldn't fix it. There is a recession. Or it could be the industry's not doing well. Whatever the reason is, he knows this is not a good situation. Besides, he's beginning to realize that every time he goes in to sign this paperwork, the bank is taking liens on all the assets of his business. That's right. And not just liens, blanket liens, which means in a sense that the bank is over-collateralizing themselves because they now are getting more collateral than what they're really owed. And they're taking them on all the factors of production for you economists out there. They take it on land, on labor, and on capital. That lien applies to all three of them. Now, what do we mean by land? Well, land, you know, where the business is, where the warehouse, the locations, the branches, they got it. The property of the business. And not just the real estate. This reaches over to all the assets of the business. They got the accounts receivable too. This could represent millions of dollars. And not only that, they got all his inventories under the lien. Even the inventories the business hadn't even paid for yet, they got them. Now, how do they take a lien on labor? Does that mean the bank takes a lien on all my employees? No. This is you, the business owner. And that's through the personal guarantee. Because this is how banks pierce the corporate shell, go right to the business owner's personal assets, which includes his home, his residence, and anything else he owns personally. They got it all. Capital, remember what Ryan said? But capital, in this sense, we're talking about equipment in this sense. Equipment, all the equipment comes under the bank's lien. Equipment, furniture, fixtures, it's all under the bank lien. Well, as this is happening, and the business owner sales are going down, what do you think these guys are doing? They're examining the financial statements, and they're realizing there's a bank involved now, and every time they ship in goods that's coming under that bank lien, they start to pull back credit. Well, the business owner at that point is in a death spiral. His main goal right now is somehow or another coming up with a big pile of money to get this bank off its back. That's hard to do when you get in a situation like this. Not easy. But if he doesn't do it, this business is going to go down. Now, if this happens again, the business owner is not going to get any more calls from his friend at the bank because this file's been turned over to another department now, the special assets department of the bank. And Jim doesn't even know these guys. He doesn't have any relationship with them at all. And they're not thinking about helping Jim. They're wanting to get out of the situation. They want to be paid. That's all that bank is interested in right now, is getting paid. Now, you think that's hard for a bank? Not at all. How do they do it? In bankruptcy court. That's how banks get paid. Bankruptcy. Now, why is that? Well, because in bankruptcy, the bank is the secured creditor. Everyone else is unsecured. And I'm sure you can see that by now. I mean, they're controlling his entire cash flow, and they got a blanket lien on everything. They're secured. So the bank needs to put this business into bankruptcy to get paid. Can they do it? Is it easy for them? You bet it is. They can do one of several things. They could foreclose. That'll do it. They could call the notes. That'll do it. Or they could put the final stranglehold on him. Cut off his line of credit. At that point, it's done for. The business owner seeks now protection in bankruptcy by filing a Chapter 11, which gives him 180 days to come up with a plan to get out of this mess. What's the plan? He's got to raise the money somehow. Really hard to do when you're in bankruptcy. If that 180 days goes by and he's not able to get that money, then the bankruptcy court is going to adjudicate this business into a Chapter 7, liquidate the assets under a fire sale, and the bank will get the first proceeds on the sale of those assets. They'll get paid 100 cents. Everyone else is going to wind up getting pennies on the dollars. Now, who are them? Well, the stockholders of the business, Jim and his associates, and these guys, the unsecured creditors. Now, at this point, as I'm talking to audiences, I'll get business owners say, you know, Carlos, I don't disagree with any of this. It's true. I've seen this happen. But you know what? I've been in business 30 years. I've never had this kind of situation. You know, I've never had this kind of situation. But I'm not disagreeing. I say, they happen weekly. So what are you suggesting? I'm suggesting you take every available cash flow that you have, any excess cash flow, and you use it to set up your own private alternate bank. Every available cash flow, sweep it in here, get it started, because this bank will mimic and do everything this other bank will do. It'll give you lines of credit. It'll provide you loans. Sorry. It'll do the same thing. You need to set this up, begin to wean yourself off completely away from this commercial bank. This bank not only gives you loans and lines of credit, it also affords you tax benefits. Well, you don't get that over here. On top of that, this bank of yours also pays you in the form of interest and dividends. You don't have that happening over here. Better still, the terms on the repayment of these loans are so flexible, there's nothing like them in the entire financial world. Nothing like them anywhere. Because the business owner can pay them back on his own schedule, when he wants, when he can. And I'll go as far as to say, if he chooses not to pay him back at all, he can even do that. On top of that, no liens on any of the business assets. That's freedom. You don't have to deal with this mess. Again, the business owner will say, wow, all right, you're wanting me to break my relationship with the bank, but I'm telling you, I've had a great relationship with them. I mean, I'm doing well, but you know, this thing over here that you're talking about, I'm intrigued. Never heard of such a thing. Where's it come from? And I say, well, it doesn't come from the commercial banking sector. It doesn't come from Wall Street. It actually comes from the insurance sector. But I want you to make sure you're hearing me, because I'm not just talking to business owners and then getting away from the commercial banking sector. I'm talking about everybody. Because being a depositor, just being a depositor in a commercial bank has gotten riskier than ever. And why is that? Well, because of two laws. Two laws. Now, the first law, it's been in this country since the country was formed. It came from England, and so our banking system just absorbed it. Now, nobody's ever paid any attention to it. A lot of people don't even know about it. But when we had the 2008 financial crisis, some people started to wake up to that law. Because here's how that law works. Now, I know that these days, most of us make our deposits in commercial banks without going inside the branch. We do it all electronically. It's easy, it's fast. But there's still millions of people that go through the drive-through. If you're a business that takes in a lot of cash, you'll go through that drive-through 3-4 times a day, several times a week. Many people go through there to deposit their checks. And they all do the same thing we do. You roll down the window, stick your hand out, pull out that plastic container. You all know what I'm talking about. And that's where we put our checks and our deposits. Drop it down that tube. Sometimes, you know, that tube is transparent. You can see that canister just flying. Goes over there to the teller. It's really, they take your money so fast. The moment that teller puts her hand on that canister, the title to your money changes hands. It is no longer your money. That money now belongs to the commercial bank. That is the law. And they can take that money and they can gamble it away if they wish. Now, they do owe you the money, yes, but legally, It is now their money. See, you thought you were just putting in there for safekeeping. Hold on to it until I get ready to pay my bills. No. They now own the money, and you are nothing more than a creditor of the bank. That's the law. Now, what's made that law even uglier is on account of another law. Now, this law was ratified in July of 2010. It started being formulated by Congress after the 2008 financial crisis. It's got a long name. Its short name is the Dodd-Frank Act. For several years after it came out, people didn't even know what it was. I don't blame them. The document is over 1,000 pages long. Who would read the thing? If you understand bankruptcy law, you can read it. I read it. There's a lot of reasons that they put that law in effect. One of them is because when the 2008 financial crisis hit, people fled the investment markets. And when they fled, no one would come back because everything crashed. All right, they just didn't want to have anything to do with investments again. They were that scared. So the law was to bring them back into the markets. Another reason for the law is because they wanted the too-big-to-fail financial institutions to bolster up their reserves. And the third reason is that they developed an expedient way to liquidate these too-big-to-fail financial institutions if they should fail again. A way to liquidate them. Why? Because Congress declared in that law that if we have another financial crisis similar to what we had in 2008, there will not be any taxpayer bailouts. They will not do that again. They'll probably have riots in the streets if we do that again. What they will do instead is this. If your bank fails, they'll close that bank down and sequester it. No money will come in, no money will go out. Then they're going to have the officials come in, Federal Reserve, SEC, FDIC. They'll pool together the money of the stockholders of that bank and the monies of the creditors of that bank. Who did I say the creditors were? The depositors. They'll take that money with the stockholder money, pull it together, and they will attempt to resuscitate that failed bank. That's how they want to deal with it, because when these too-big-to-fail financial institutions fall, not one of them falls. A bunch of them fall, just like falling dominoes. They pose a systemic risk problem for the whole financial system. So this liquidation process deals with that. Now, thank God we haven't experienced that kind of bail-in, but we've seen several examples in Europe. The first one was in Cyprus in 2013. The people in Cyprus woke up one weekend morning, getting ready to do their weekend shopping and dining out. They go to their ATM machines. They can't get any money out. It spooks them. The branch is closed. They get in their car. They drive over to the main headquarters. It was the largest commercial bank in Cyprus, and what they find there is a huge crowd of people. They're all there for the same reason. They want their money. But the bank is closed. There's a sign on the door and said that it was closed until further notice. And do you know that they stayed closed 12 days? 12 days. They were shut down. Can you survive without getting to your cash for 12 days? How do you make payroll? How do you pay your expenses? And this is why during that 12-day period, many businesses in Cyprus failed. When they open the doors again, some of the depositors got all their money back, the smaller amounts. The rest of the depositors got one of two pieces of paper. One of them was a promissory note saying that if they were able to succeed in resuscitating the bank, they would see their money back, or they got a stock certificate, a stockholder in a defunct bank. Now, when it all played out, the bank failed, depositors lost 85% of their money. And we've seen several cases of this. So, again, I say, take every available cash that you can and set up this alternate bank. Wean yourself away from this as quickly as you can. We have another crisis coming. Now, at this point, people in the audience raise their hand. Carlos, I don't know that I have to be, I got the FDIC. I mean, seriously, they will jump up and say that. And I don't argue with them. I mean, they do. They have the FDIC. But I don't want anyone to be naive because we all have a short memory. During the 2008 financial crisis, we had 1,200 banks that went underwater. 1,200. There's only around 3,600 commercial banks in the whole Federal Reserve System. 1,200 of them went underwater. So yes, ma'am, yes, sir, the FDIC was very busy, shoring up bank accounts, going around all over the country. They ran out of money. The FDIC ran out of money. At one point, they were $25 billion in the hole. The only way they were able to shore up and pay everybody depositors was to go get a loan from the Treasury Department. When we talk about the FDIC, that's where the federal comes from. They have a line of credit to the Treasury, but Dodd-Frank says no more taxpayer bailout. So I'm not sure you have the FDIC. Besides, when I last checked, if you look at their website, I think it was in October I checked, the FDIC had $88 billion, which is a pretty significant sum of money to deal with bank depositor money. And I'll give it to them. This is twice the amount of what it was in 2008. So they've beefed it up. But the total of U.S. bank deposits, the ones that they are insuring, is $7.1 trillion. So I like to tell people, I would just like for you to just look at the disparity between these two numbers, 88 billion to 7.1 trillion. For those of you that are good with a calculator, you can do the math. How much, maybe they have, FDIC has 1% enough money to cover all of bank depositors' money. If you have money deposited in a commercial bank, you are a creditor of the bank. And yes, you've guessed it. You're unsecured. Thank you. Now, I have explained and sketched out the financial problem facing the typical business owner. In fact, I stress to you that most business owners do not realize the stranglehold that commercial banks and their lines of credit have on them until it's too late. management services on much more generous terms than the commercial banks. Business owners would be able to sweep excess cash into such an alternative and gradually wean himself from dependency on the present system. Fortunately, there is such a vehicle. The alternate bank is IBC.
Well, thank you. And I hope that you enjoyed this presentation. And contact me at jorgeeherrera.com if you want more information about the infinite banking process. So I'll see you next time.